You check your bank account. The number looks fine. Not great. Not terrible. Fine. Then you picture someone in the top 10% of earners. You assume they just make more. That's the whole story, right? It isn't. Because income and wealth are not the same thing, and the gap between the two is where almost everyone gets stuck. Some of the highest earning people you know are one bad year away from trouble. Meanwhile, someone making a fraction of their salary is quietly building something that lasts. The difference isn't the paycheck. It's what happens to the money after the paycheck lands, and the patterns separating those two groups are more specific and more learnable than most people realize. Before going further, if you've ever wondered whether your habits with money actually matter as much as your income does, hit that subscribe button now. This channel breaks down exactly how wealth gets built in real numbers, not motivational slogans, and you won't want to miss what comes next. Now, back to the top 10%. Start with the most basic fact. According to the Federal Reserve Survey of Consumer Finances, the top 10% of households by wealth hold a share of total net worth that is often reported as somewhere near 2/3 of all household wealth in the country, though the exact figure shifts depending on the year and methodology used. That's a staggering concentration. But here's the part that surprises people. A meaningful slice of that top 10% didn't get there primarily through salary. They got there through what they did with the difference between what they earned and what they spent. That gap has a name: savings rate, and it's one of the clearest dividing lines between people who build wealth and people who don't. The Bureau of Labor Statistics tracks consumer spending patterns through its Consumer Expenditure Survey, and one pattern shows up again and again. As income rises, spending tends to rise right along with it. Economists sometimes call this lifestyle creep, though you may have heard it called lifestyle inflation. A raise arrives. The car gets nicer, the apartment gets bigger, the dinners get pricier. Nothing dramatic happens in any single decision, but the gap between income and spending, the gap that's supposed to turn into wealth, slowly closes without anyone noticing it happen. People in the top 10% of net worth tend to interrupt that pattern. Not by living in extreme deprivation, by keeping a portion of every raise, every bonus, every windfall completely untouched by lifestyle upgrades. Research on high net worth households, including work popularized by financial researchers like Thomas Stanley in his studies on millionaire behavior, suggests that many wealthy individuals live well below what their income would technically allow. Stanley's surveys, conducted over decades and later summarized in his widely cited writing on the habits of American millionaires, found that a large share of self-made wealthy people drive modest vehicles, live in moderately priced homes, and would not be recognizable as wealthy if you passed them on the street. Why does that matter to you? Because it reframes the entire question. The goal isn't to earn like the top 10%. It's to spend like someone who hasn't seen the raise yet. Here's a question worth sitting with. If your income doubled tomorrow, would your spending double right along with it? Be honest. For most people, the answer is yes, eventually, even if it doesn't feel that way in the moment. If that question made you a little uncomfortable, drop a comment below with your honest answer. This channel runs on exactly that kind of honesty. And reading what you write helps shape what gets covered next. The second pattern is less about restraint and more about direction. Where does the unspent money actually go? For most households, savings sit in a checking or savings account, earning whatever the bank feels like offering, which in recent years has frequently lagged behind inflation according to data the Bureau of Labor Statistics tracks through the Consumer Price Index. That money isn't growing. It's quietly losing purchasing power while it waits for a decision that never gets made. For the top 10%, Money rarely sits still for long. It moves into assets that have historically appreciated over time: equities, real estate, retirement accounts that compound for decades without anyone touching them. The Federal Reserve's survey of consumer finances has repeatedly shown that wealthier households hold a disproportionately large share of their net worth in financial assets like stocks and retirement accounts, while households with less wealth tend to hold a larger share of their net worth in their primary residence alone, if they own a home at all. This isn't about timing the market or picking the perfect stock. It's about exposure. Time in the market, consistently, tends to matter more than any individual decision made within it. $1 invested in your 20s has decades to compound. $1 invested in your 40s has far less runway. Same dollar. Wildly different outcome. That's not a tip. That's arithmetic. So why doesn't everyone just do this? Partly because investing can feel inaccessible, confusing, or risky when you're starting from very little. Partly because of a third pattern, one that's harder to quantify but shows up constantly in financial behavior research: debt. Specifically, the kind of debt that doesn't build anything. Credit card balances carried month to month. Financing for things that lose value the moment you drive them off the lot or unbox them. The top 10% isn't necessarily debt-free. Many carry mortgages, and some carry business loans. But the debt tends to be attached to something appreciating or something generating income, rather than something that's already losing value while you're still paying for it. Surveys on consumer debt, including work referenced by organizations studying household finance, consistently point to revolving high-interest debt as one of the strongest predictors of stalled wealth building, regardless of income level. A household earning a comfortable income but carrying persistent credit card balances can end up with a lower net worth than a household earning less but carrying no high-interest debt at all. Income tells you what comes in. Debt tells you what's already spoken for before you even decide what to do with it. Does that land differently than you expected? For a lot of people it does, because debt rarely feels like the enemy in the moment. It feels like convenience. There's a fourth pattern worth slowing down on, because it gets discussed less often than spending or investing: insurance against ruin. Not insurance in the sense of buying every policy a salesperson offers, but in the sense of protecting the wealth that's already been built from a single catastrophic event, undoing years of progress. An emergency fund covering several months of expenses. Adequate health coverage. The right amount of life insurance if other people depend on your income. None of this builds wealth on its own. What it does is prevent a single bad month from forcing the liquidation of investments at the worst possible time, or from forcing high-interest debt back onto the table just to cover an unexpected expense. Financial planners who study household resilience often point out that the absence of a safety net is one of the quiet reasons wealth-building efforts get derailed, even for households doing everything else right. A car breaks down. A medical bill arrives. Without a buffer, that bill gets put on a credit card, and suddenly, the progress made over the past year gets erased in a single transaction. Put these patterns together, and a picture starts to form. Spend below your means, even as those means grow. Direct what's left into assets that compound, rather than accounts that quietly lose value to inflation. Keep debt limited to things that build, rather than things that drain. And protect all of it with a buffer large enough that one bad month doesn't undo years of discipline. None of this requires a six-figure income to start. It requires a sequence, and sequence is something almost anyone can copy, regardless of where they're starting from. Here's the part that tends to get overlooked. The top 10% isn't a fixed club with a locked door. According to research drawing on IRS and Federal Reserve data, There is measurable movement in and out of top wealth brackets over time, particularly across decades and generations. People move into that bracket. People also move out of it, often because the underlying habits, not the underlying income, changed. It helps to look at what separates the top 10% from the bracket just below it, because the gap there is rarely about raw income. Survey data on income versus wealth distribution consistently shows overlap between households earning very similar salaries while sitting in completely different wealth brackets years later. A surgeon and a small business owner might report comparable household income on paper, yet one ends up with several times the net worth of the other once retirement accounts, home equity, and investment portfolios are tallied. The explanation almost always traces back to the same handful of variables already covered here: savings rate, asset allocation, debt structure, insurance against ruin. Income explains the ceiling of what's possible. It rarely explains the outcome by itself. There's also a generational layer worth mentioning, because wealth doesn't always start from zero for everyone. Some households in the top 10% benefited from inherited assets, family-funded education, or a head start that has nothing to do with personal discipline. It would be misleading to pretend otherwise, but research on intergenerational wealth, including studies tracking how inherited wealth gets preserved or lost across generations, often finds that inherited wealth without the underlying habits tends to erode within a generation or two. The habits aren't just how people get into the top 10%. They're often the only reason wealth stays there once it arrives. That's worth repeating in a different way. A head start can open the door. It rarely keeps you in the room. If you've made it this far, that probably means this kind of breakdown is actually useful to you, and that's exactly the kind of viewer this channel was built for. Tap that like button right now. It's a small action on your end, but it tells more people exactly like you that this video is worth their time too. There's one more pattern, and it might be the most overlooked of all: patience with the boring middle. Wealth building has a recognizable shape. In the early years, the growth feels invisible, almost insulting compared to the effort going into it. A modest investment account barely moves for what feels like a long stretch. Then, gradually, compounding starts pulling its own weight, and growth in later years can outpace years of contributions combined. People in the top 10% of net worth, especially those who built wealth gradually rather than through a single windfall, tend to have simply stayed in the game long enough to reach that inflection point. Most people who give up on investing do so during the boring middle, right before the curve would have started bending upward. It's also worth saying plainly that none of this is about shame. Plenty of people carry debt they didn't choose, started saving later than they wanted to, or are still working through circumstances that have nothing to do with discipline. The point of laying out these patterns isn't to suggest that anyone who hasn't reached the top 10% is doing something wrong. It's to show that the path there is built from specific, repeatable decisions, rather than luck or raw income alone, which means the path is available, starting from wherever you happen to be standing right now. So if there's one takeaway to walk away with, it's this: stop measuring yourself against your income and start measuring yourself against the gap you protect. The gap between what comes in and what goes out, and what happens to that gap once it exists. That gap, protected consistently over years, behaves less like a number and more like a direction. It either points toward more freedom over time, or it quietly erodes. If this kind of breakdown is useful to you, there's a comment section below worth using. Ask the questions you actually have, not the ones you think sound smart, and this channel reads every single one. And if you want the next video the moment it goes live, the subscribe button does exactly that. Like, comment, subscribe. 3 small actions, and every one of them genuinely helps this channel keep making videos like this one. Next time, the focus turns to a number people chase, without fully understanding what it actually measures and why hitting it doesn't guarantee the security most people assume it does. You checked your bank account again. The number still looks fine, but now you're not looking at the number. You're looking at the gap behind it, and for the first time, you know exactly what to do with it.